Hello, I'm Connie Phelps, counsel at Barron Zweig Leonard. I head up our corporate and M&A practice. Thank you for joining us today. We will be discussing the ins and outs of executive compensation and how companies can devise successful executive compensation strategies. I'm delighted to have as our guests in the studio from Morgan Stanley several individuals. We have remote Tom Conlon, who is the Executive Director of Morgan Stanley at Work. And in studio with us are Rick McLaughlin, who is the Executive Financial Services Director, and Mitch Kernus, Senior Vice President at Morgan Stanley. Welcome to you all. As I mentioned, today we'll be discussing the ins and outs of executive compensation, and we want to focus on how companies can devise strategies to both attract and retain top talent, and then what businesses should be focused on in terms of their equity plans when they are looking toward a liquidity event. To start off our conversation, we would like to ask Tom Conlon to discuss a little bit more about Morgan Stanley at Work and how that platform can benefit businesses. Tom, why don't you tell us a little bit more about Morgan Stanley at Work?
Thank you so much, Connie, and really appreciate you having us here today. Morgan Stanley services thousands of companies in their equity program administration. In fact, we cover over 40% of the S&P 500 and over 40% of the Russell 3000 and several thousand additional private companies. Equity programs are an extremely useful tool for companies to not only attract, but also retain key executives in the organization. Morgan Stanley services over 6.5 million equity plan participants, and equity programs make up a substantial portion of their net worth. Therefore, these programs are really meaningful to these executives and also the companies that they serve.
Rick, why don't you tell us a little bit more about the specifics of Morgan Stanley at Work and how companies can use that platform to both devise and then implement their executive comp plans?
Sure, thanks, Connie. So it's very important in the world of equity compensation that your plan is designed in a way that not only complements what you want to do as a company, but it helps your employees become integral parts of the growth of the company and feel like they're invested in the growth of your company. And that really doesn't matter whether you're a private or public company. Those are issues that are relevant to any executive. So we find that what Morgan Stanley is able to do is, because of our broad exposure to the markets, we have plans that are able to service both very small companies, especially on the private side, to provide things like 409A valuations and cap table management, allowing companies to have good full control of their equity, to the largest public companies where there's not only that record keeping and analysis, but also the ability for employees and oftentimes specifically the executive and director population to have more of a one-on-one experience when it comes time for them to sell their stock over time. We feel that it's very important for executives and employees at these companies that own equity to understand what they have well before they're in a position to sell anything, for instance. It's important that they understand how they fit in the role of the company and how equity compensation fits as a piece of their overall compensation. It's really easy for an employee to understand if they're being paid in cash. But if they're getting equity where maybe it's not tangible for them today, it's important for them to understand what the future liquidity opportunities look like. It's important to understand how that equity dovetails in with their overall financial plan. And we think that's very important, that it doesn't get looked at as a standalone piece of their finances. And Morgan Stanley stands available to help companies with the education process to help the employees understand what they have and make the best use of their equity.
Excellent. And now we talked, you mentioned this a bit, I think, or at least alluded to a liquidity event. Mm-hmm. And one thing that I have seen come across my desk more frequently these days is incentive plans that are tied to liquidity events in a company, specifically a change of control. Mm-hmm. And we've devised a number of plans for companies where they allow their executives and key employees to kind of participate in a change of control. Mm-hmm. and they allow their individuals to participate in the upside, frankly, when a company goes through a change of control. Is that something that you're also seeing in the market? And tell us a little bit more about some of the strategies that companies are using when they are looking toward a liquidity event.
Sure, that's actually a really good question. We see a lot of that in that transition stage where companies are having some sort of liquidity event, whether it's an IPO, a SPAC, a merger, some sort of a tender offer, some way of liquidity being presented to their employees. And what we try to do at Morgan Stanley is help companies prepare for that. And there's a number of things we think is really important for the company to do in advance of that happening that dovetails nicely with what is beneficial to the executive and just the broad-based population that owns shares in the company. So for instance, we think that equity administration has got to be near the top of the list of things for companies to be concerned about when they're going through this transition. Obviously, it's important for their data to be accurate, because if you're doing some kind of liquidity event, the information in your cap tables and your 409A valuations have to be accurate for anyone to make any kind of a transaction associated with your company. We feel that equity compensation, your provider typically will be able to do those 409A evaluations and manage the cap tables for you. But we think that transition time is really an important time to think about optimizing your processes, making sure you understand how that equity is going to be handled in the result of a transaction taking place. You want to get your compliance squared away. There'll be potentially totally different compliance regulations if you're a public company as opposed to a private company, and you want to address those situations well before the IPO. That's not something where you want to be figuring it out on the fly, right? You want to be doing that far in advance. And then we think it's very important to engage your shareholders, those executives or regular rank and file folks that have equity. We think it's really important to engage them early on for a number of reasons. One, you want to make sure your current provider can handle the transaction, especially if you're going public. Many of the equity administration providers out there can only manage a private company record keeping. And so it's important, if you're going to be moving to the public markets, that you're working with a provider that can handle your plan even if you become public. You don't want to be going through a transition for your equity plan at the same time you're trying to manage an IPO. There's just too many things going on all at once. We also think it's very important to educate your employee base so they understand the value of what's going on. There's definitely situations where employees don't really understand or appreciate the value of their equity until there's some liquidity. Otherwise, it's just a piece of paper that says they have some value. But once that liquidity event is happening, you want to really be out in front of educating them on what's going to happen and how hopefully this liquidity is a good thing for them, about the timing. You want them to understand about splits and whether there's dilution and different kind of things, so they really understand what they're getting into should this transaction take place. Again, whether they're going to a merger or some kind of a buyout or an IPO, all these things are pretty much the same regardless. You want to discuss things like liquidity. Is there a lockup post-IPO? So they really understand what's going on. We feel it's critical to the success of a transaction that those shareholders are really fully on board understanding what's going on and understanding why it's valuable to them, because you want that event to be a positive emotional experience for the company. And if people are sort of sitting around uncomfortable or unfamiliar with what's going on, then they won't be as active a participant in the experience. And that's really what we want to do, to the point where Morgan Stanley has actually published reports we call liquidity trend reports that we can give anybody who's interested, that gives you an idea of what companies are typically doing as they go through liquidity events like this. So I know it's kind of a long-winded answer to a short question, but we do think that you should be able to depend on your provider to help you through a lot of these steps getting ready for any kind of a transaction.
I think you bring up some incredibly important points. That is, your shareholders are key to the success of whatever transition you're making, whether it's to the public market or if you are going through a merger, what have you. And your top executives, of course, need to be on board as well, particularly if they're staying on board.
Exactly. We want to give them the opportunity to do the planning associated with what's coming up. For instance, there's a lot of there are tax planning and estate planning opportunities they may have that they can take advantage of before the IPO or before the liquidity event happens, that you want to be able to, you as a company are not going to want to be in the position to educating your employees like that. You can't be telling them what to do, and certainly we can't give tax advice, but your provider or a company like Morgan Stanley should be able to step in and provide some guidance to those employees, especially those executives, in the way of what kind of estate and tax planning things they should be thinking about well in advance of a transaction taking place.
Very good. Tom, did you have anything that you would like to add from your perspective? I'm sure you've been through quite a number of liquidity events of all stripes and types. We'd appreciate any insights you have in that regard.
You know, Connie, thank you for that question. One growing trend that we're seeing is deferred compensation, which is another important piece of compensation packages for executives. And as Rick mentioned, planning for these events during or post IPO is just entirely too cumbersome. So as companies think about approaching the public markets, if they don't already have a deferred compensation plan, it's an extremely useful tool, again, for retention of those key executives in the company, and non-qualified deferred compensation plans in conjunction with equity compensation plans really make the company very attractive for that key executive.
Excellent. Very good. Very helpful information to all of our clients, regardless of their size. One thing that I have seen also with, this is trending more toward the smaller sized companies and even the kind of getting up into the middle market, is phantom equity, that is synthetic equity plans. And this will help a company if they want to be able to attract and retain their talent, and they're not quite ready to grant actual equity to the employees. They want to kind of keep their powder dry and hold on to the current ownership structure, but allow employees to participate and kind of track the performance of the company's stock. Now, I realize phantom equity is a different ball of wax, but this is something that we have found useful for, again, the smaller size companies and even in the lower end of the middle market companies. And then when they get ready to move into granting equity and establishing equity comp plans, we know Morgan Stanley stands ready to assist in that regard as well. Tell me a little bit more. We've been talking about executive comp generally. Let's talk about the executives and how they benefit and how companies are really deploying executive equity comp plans to get that top talent, bring them into the company, reward them, show them the value of holding equity in the company as the company grows. Can you speak a little bit to that?
Sure. Again, it goes back to education. You're going to see me go back to the concept of education over and over in this conversation, because just because an executive is at a senior position in a public company especially, or a private company, or is about to get a role like that, that doesn't mean they really have a full understanding of how equity compensation works. And as I said earlier, it's difficult, not difficult, but the fact that you recruit somebody with just a cash package is easy to understand. They can tell exactly what they're going to get paid and when they're going to get paid. If you're recruiting someone with an equity compensation package, now you're asking them to get on the same side of the table, essentially, as the rest of the company owners and have some skin in the game, so to speak, for the upside of the growth of the company. The way it needs to be positioned is obviously it's not part of compensation today, but it's part of a growth opportunity going forward. And so if they are offered a package that where they can understand what they have, understand what they can do with that equity, it can be a very valuable piece of the recruiting process and the retention package. You know, when you give them equity or give an executive equity during the initial process of recruiting, if they don't understand what the liquidity is, or they don't see any ability to get any liquidity at some point, it doesn't seem as valuable to them. It just seems like something on a piece of paper that we can sit back and hope works out some way down the line. But I like to tell people when they need to look at the liquidity, because it's equity compensation. It's not called equity, hold on to it forever and hope it works out, right? It's called compensation. And at some point, you want to be in a position where you can actually realize some of that compensation. So we find it's important for companies, to the extent that they can, to talk to an executive they're recruiting about what potential liquidity events could be, whether it's an IPO, a merger, or even an internal market. We have many clients, especially on the private side, that make internal markets of their shares, whether that's a tender offer or just a matching kind of program that gives their employees and their executives maybe an annual opportunity to create some liquidity. And it's a little complicated to explain that to an employee of a private company, but that's where a firm like Morgan Stanley steps in and provides that education to sit down with those employees and help them do some planning. Again, it's important for that equity to be part of their overall financial planning picture so they understand where it fits and how it dovetails in with everything else they own from an equity perspective. We want them to talk about estate planning. Again, long-term, estate planning can be very powerful when it comes to your equity holdings, so it's important to know where that fits. Because the company, if you do proper estate planning, and I'm sure as well you well know, you can look at a discounted value of those shares when there's no liquidity. Again, we can't give tax advice or legal advice, but we would say if you're an executive looking to get a benefits package like that for the first time, it's a really important time to talk to your tax advisor and your financial advisor to help you understand what the company is offering you, and understand what it can mean to you and your family going forward. But we see at the high level executives especially, none of these compensation packages are offered without equity. Nobody's expecting just to be paid in cash any longer. And so it's really important that you kind of lay down the markers as to what this is supposed to look like going in, so there's no confusion and no disagreements years down the road when an equity situation happens.
Very good. Now, you brought up a very important topic to our listeners, and that is now you've earned the compensation, you're building your wealth. How do you deploy it? How do you continue to build on that wealth, both through your equity compensation and through your wealth management? And we fortunately have with us Mitch Kernus, who specializes in that area and helps grow the pot, so to speak. Mitch, why don't you tell us a little bit more about
Sure.
the services that you can offer to our executives?
Thank you, Connie. Yes, well, just to pick up on what Rick was saying, our job really is to tie all this together. There is a process, the wealth management process, which is a tenet of Morgan Stanley's wealth management, is to really bring together all the client's assets and do the planning that's necessary to prepare for these liquidity events, but also to account for other assets that are in a client's portfolio. And that can be, across the spectrum of many different things. And the key there is to protect and grow that money to obviously pick up on the enhancement of a liquidity event through executive equity comp. And that's what my team does. And we think right now it's probably more important than ever to focus on that process. The markets, the public markets are basically completing in 16 to 18-year run of unparalleled prosperity, which Morgan Stanley's view is this is not going to continue unabated without some volatility. And so in order to prepare for that, it's really vital that a client have a plan that incorporates the process, which is first thing is to identify what a client's needs, retirement plans are, and then to devise a plan to protect and grow that money, monitor that plan, and make changes as conditions necessitate. So we certainly realize that our job is to allocate capital. That's our primary focus. What is your asset allocation look like? How much of my money should be in stocks? How much of my money should be in bonds? How much of my money should be in cash? How does private equity compensation figure into that? And then for qualified clients, one of the things that we really find extremely important to incorporate is the concept of alternative investments. Of course, you have to be a qualified investor to invest in alternatives, but just to articulate what that means, alternative investments are things like private equity, private credit, private real estate, and other diversifying strategies that can introduce non-correlation into a client's portfolio. Because right now, as most people may be aware, the entire stock market returns for the last several years have really been driven by maybe 10 stocks. if you haven't owned NVIDIA, if you haven't owned Google, if you haven't owned Amazon, if you haven't owned Microsoft, then your equity portfolio really hasn't done very well. But because those comprise huge parts of the index, most clients have done very well. But that's called narrow breadth, BREADTH, and we don't want to have what we call bad breadth. And so what that means is diversifying properly by getting a purposeful asset allocation plan that incorporates all these elements, especially alternative investments where appropriate. And that's really a vital thing to do right now.
And as you said, in particular, as you see the potential for more volatility in the market,
Yep.
then that's where your expertise comes into play, and you can help guide investors so no one gets spooked if
Well,
there's a turn of events.
That's exactly right, because what you really want in your portfolio is investments that will zig when the market zags. And there's so many risks out there right now. There's the election, which is creating a lot of uncertainty. There is the geopolitical situation, which always exists, but seems to be coming to some kind of a head right now. But probably the thing that affects investors most is inflation. And inflation is and will continue to be a problem. The statistics that are reported on a monthly basis don't really reflect how it really hits home to the average family with consumer prices continuing to rise. And since the consumer is 2/3 of gross domestic product, and the consumer is pulling back right now because of inflation. The Federal Reserve recently cut interest rates when they did this 50% cut just recently at the most recent Fed Fund meeting. But interestingly enough, the bond market is not reacting to that. In fact, it's doing the opposite of what the Federal Reserve wants right now. Interest rates have actually risen since the Federal Reserve cut rates, which is the opposite of what they wanted and what they expected. So what the bond market is telling you is that inflation is not really going away. And in fact, it's very sticky. Most investors today have never experienced inflation before. You have to be our age to remember when interest rates were in the high teens, and they've never seen interest rates literally go up. We've been in a 40-year bull market for bonds, which means interest rates have been coming down for 40 years. That's changing now, and we don't think that we're ever really going to go back to what they call ZIRP, zero interest rate policy, which the Federal Reserve implemented to try to stimulate the economy really as a result of the great financial crisis of 2008. That's when they started this program known as quantitative easing, and that's what really has ignited the equity markets to the stratospheric levels that they're at right now. It's critical that you get good advice, and that advice includes things that can really add what, again, call non-correlation into your portfolio. Because if you're just going to rely on continually rising stock prices to create your wealth, at some point you're going to be disappointed. So we want to prepare for that.
And of course, our executives, hopefully many of our executives who are listening also have at least a portion, perhaps a significant amount of their wealth in their businesses, and thus the discussion of executive equity compensation today. I can't thank you gentlemen enough for taking the time out of your busy schedules today to share in this discussion. And a big thank you to our listeners. I hope that it's been beneficial to you as well. And from the Barron Zweig Leonard Studios, have a very wonderful day. Thank you.
Thank you. Thank you.
Thank you, Connie.